Hello, everyone. Welcome. Thanks for joining our session. Our speaker today is Arvind Rajan. He is the co-founder and managing partner at BasisPoint GlobalSolutions. Please join me in welcoming him to the...
Thank you very much, Patricia. It's a pleasure to be here this afternoon. At least it's the afternoon here in the northeastern US. And for the next 15 minutes or so, I'm going to walk you through some of the interesting challenges that have arisen from the COVID-19 crisis, specifically for the application of AI and machine learning techniques to investment management. So let me, without further ado, share my screen. And I'll try and keep this presentation to approximately 15 minutes. So, as I said, I'm going to speak about some of the new challenges for AI/ML-based asset management in the post-COVID era. And basically, the agenda is as follows. We're going to talk about some of the historical patterns of medium and long-term investment that have been broken. You know, both the potential returns and the risk have changed. And this is a challenge for machine learning-based methods, which may not have had time to adjust to the changes. In particular, I'm going to show you how the massive monetary and fiscal stimulus have distorted prices, how return expectations in certain asset classes have changed dramatically, and fixed income is a particularly good example of that. I'm going to talk a bit about the changes in market structure and liquidity, and I'll show you how there was some pretty significant anomalous behavior in many assets, and I'll choose corporate bonds and treasuries as two examples of that. And finally, and not least, there have been some pretty important changes in the statistical relations and correlations between different major assets and asset classes. And this particularly applies to the equity markets, where there's been a pretty significant bubble in tech stocks, which has actually been, oddly enough, exacerbated as opposed to pricked by the virus. So we will conclude then with some of the lessons and takeaways for machine learning practitioners who are trying to put some of the signals that they perceive in historical prices into play in predicting returns. I want to begin by saying that the set of things that I'm going to be talking about applies to a particular part of type of application of AI and ML. It is to do with medium-term applications of artificial intelligence and machine learning to the problem of predicting financial time series, specifically returns and risk. And it is, it is in this area that machine learning has had perhaps the least obvious success. Whereas in other areas, for example, if you were to look at operational applications such as anti-money laundering, for example, or the application to improve the flow of information and selection of information that asset managers use, it's been very successful. Similarly, if you were to home in on much higher frequency and short time periods, seconds, milliseconds, minutes, then the fact that things have changed may be less of an issue for machine learning. There, I think it's okay. But when you look at longer, medium time periods, and you look at the ability to forecast returns and risk, here, I think that there are some really formidable challenges. These challenges already existed before the COVID crisis. The non-stationarity of financial time series data, and in particular also the non-ergodicity of that data, that is that cross-sectional distributions differ from time distributions. The heightened risk of spurious causality caused by big data, the fact that you have a lot of different kinds of data series and you're likely to find some relationships which may not hold in the future. And the crowding, because of the existence of many quantitative equity managers who may be already incorporating signals that are common, and those signals then lose their power. All of these had been issues for artificial intelligence and machine learning even before COVID, but COVID's actually exacerbated these and added new challenges. So let's begin with the massive changes that have occurred due to the crisis. The first set of changes, two changes in particular, are fiscal and monetary stimulus. So I will speak first about fiscal. Globally, we have more than $9 trillion of fiscal stimulus coming in. The fiscal measures that different countries have put in are on the bottom left-hand chart. Some of them are in the form of direct stimulus, some of them are in the form of loans, but their impact varies from country to country in terms of which sectors are most affected and which particular securities might be most impacted. A lot of the data for this is not yet in the models that are going in, and so the models have to scramble to catch up. On the right-hand side, you look at the monetary stimulus, and you can see that there's been a very sharp increase in monetary balance sheets, in central bank balance sheets, of the order of approximately $6 trillion. And this number is likely to grow as time goes on. This too is spilling over as extra liquidity into various markets, and it may explain the rapidity with which equity markets recovered in the last 3 months, even though the fundamentals of the global economy have not. And this, again, is likely to be a challenge for models that are driven by data and for whom the even if that variable of central bank balance sheets and monetary stimulus was already a part of the input, it is unlikely that the relationship between that and the recovery in the markets has been properly captured. The third and fourth changes have to do with changes in the market, because the market itself has repriced enormously and sectors have changed in their value, in their fundamental value and in their future prospective returns, and relative value changes. So one-off changes driven by stimulus, fundamentals, technicals, and price moves have all shifted rather dramatically. And the question arises as to where these stimulus relationships can be found for a machine to learn from. And can this new information be successfully incorporated into the inputs of an ML model? So let me begin with returns here. So here's an example of a massive change in future returns. We now have more than $5 trillion of negative yielding bonds in Europe and Japan, and the US yield is now converging towards zero. And many of the key benefits of owning bonds have eroded: safety, liquidity, income, and the fact that they provided a deflation and growth hedge are all much less so than before. We also have higher risks with bonds because we now have a greater exposure to potential future issuance, since the fiscal stimulus has to be paid for. And inflation may be ignited by this fiscal stimulus and or some of the monetary quantitative easing. At the same time, people have not sold their bonds. Institutions have been forced to match their liabilities and hang on, even when bonds have negative yields. But over time, there is likely to be an erosion in demand as the 60-40 model of equities versus bonds in traditional asset allocation models comes increasingly under scrutiny. Government entities and regulators also have played a big role in driving these ownership, not only through rules, but by direct ownership, as you can see on the bottom right-hand corner graph. And on the left-hand side, you can see how the majority of the universe has really, really low returns. The question you have to ask whenever fixed income is involved in a machine learning model is, how many of these facts are actually known to these models? And these facts are now become much more important. Can they be incorporated? Should they be ignored? Now, we all know that in fixed income, the yield is a really good point estimate of future returns. So on the left-hand side chart, you can see how over the last 100+ years, the yield of a 5-year intermediate government bond index has been an extremely accurate predictor of its return 5 years later. Now, the COVID-19 crisis has actually killed the prospects for returns for the $100 trillion of fixed income bonds around the world. On that same left-hand chart, you can see a little red X at the bottom right of the chart which represents the current value of the yield. It is below 0.5% for the short-dated US government bond index. And at that rate, the expected Sharpe ratios and information ratios are extremely poor. The returns will be of the order of 0.5% or less for the next 5 years. Is that known to the models? And suppose it is known, how does that change how one should think about volatility? How should one think about the skewed risks potentially to the upside in terms of yields or to the downside in terms of returns? So traditional considerations and correlations may fail when yields go from positive to negative, because we know that, for example, in Europe and Japan, yields have not been able to fall much below 100 basis points. Obviously, on the positive side, they could go much higher than that, particularly if inflation picks up. So boundary conditions apply, but we don't have a lot of experience in what happens after you cross that boundary between positive and negative rates. On the right-hand side at the bottom, you can see the new projections that we made for the yields as of last month and the estimated potential information ratio that you could expect to experience for various categories of fixed income securities in the future. Those information ratios or Sharpe ratios are at the lowest they've been in a very long time. And it's unclear if machine learning models know this or whether they're able to incorporate this in a dynamic fashion. Another major issue that occurred during the COVID crisis is the change in the market structure and liquidity of various instruments. Here you can see the bid-offer spreads of corporate bonds as represented on the left-hand side through the spreads and on the right-hand side through dealer inventories. And basically, during the period of the crisis, dealers abruptly changed their behavior. They stopped acting as principal for trades, and they treated themselves primarily as agents. On the right-hand side, you can see that the inventories of bonds actually went down. But once the market began to recover, they rapidly began to buy the bonds. This type of behavior was driven in part by regulation and in part by the self-interest of dealers. The over-the-counter nature of the market essentially allows dealers to a lot of latitude in how they respond to price changes in a crisis. So in combination with the stricter regulatory environment in the post-global financial crisis era, there's been a lot of dealer risk aversion, and that dealer risk aversion showed up here. Similar to corporate bonds, structured and sovereign bonds also had the same type of reaction, became very illiquid. Now, if you look at what happened after March, there was a very rapid recovery in liquidity. And the reason for that was primarily the Fed. So the Fed decided to step in on a certain day with QE, liquidity provision, etc. And that immediately corrected this problem. Something similar occurred here on the next page here. I'm showing you the spread between on-the-run and off-the-run treasuries on the left-hand side, and the spread or the gap between treasury futures and the underlying treasury bonds. All of these went haywire briefly in March, and then once the Fed stepped in, things went back to normal. So the question that one has to ask is whether the structural changes in liquidity and market structure can be taken into account by a model which has only historical data built into it. And even if we have regime shifts built in, the new regime is one that has not really been encountered before. The Fed had never stepped in as quickly and as massively as it did in this case to restore liquidity, and potential changes in the market structure in the future are still unknown. A third element has to do with the changes in correlations between different asset classes and within asset classes. So here, let me give you an example of equities. So on the bottom left-hand side, you can see the divergence between tech growth and small cap equities. And that divergence, instead of narrowing, instead of the tech rally ending, instead actually became much more divergent after the crisis. On the right-hand side, you can see that in the post-crisis period, we've had some bubble stocks, stocks like Nikola and Zoom, which are defying all kinds of rational expectations for where their prices could go. These segments, and this is primarily a large cap tech stock type of a rally. Healthcare is another element of it. And it is sufficiently strong for us to perhaps call it a bubble. And if there's a bubble there, it was already underway pre-COVID. But the question now is, how permanent is this effect? And can machine learning really predict when that trend would reverse? There are some pretty good reasons to think that the virus might be blowing the bubble. There's a modeling nightmare here, because the truth is the elements that are leading to the virus being connected to the bubble are all one-off elements. There is a stay-at-home economy promoted by the virus, which accelerates the adoption of technology. There's a relocation of capital from sectors like travel and small cap and commercial real estate into the technology sector. There's a work from home culture, which allows day traders on platforms like Robinhood to buy Tesla. And there is a benefit of rate cuts and quantitative stimulus, and that has flown disproportionately to those sectors that have been immune to the problems of the virus. The question is, will all this reverse with a recovery and a vaccine, or will these changes remain permanent? I believe that machine learning is unlikely to have the answers. So to conclude, we have a number of takeaways for AI/ML practitioners, but most of them are questions rather than answers. I would say basically that if you think about the formidable challenges that AI/ML faces to begin with in medium to long-term alpha generation, those have not really been solved, but in fact have been exacerbated. Because COVID-19 has introduced some sharp discontinuities into the data set. We are now in a sparsely populated new regime. Time series forecasting is even more suspect than during normal times, especially for lower frequency, medium to long-term alpha signals. And large agents like central banks have changed the rules and will continue to do so. We now have a lot of new data streams. Many have to be very useful to us in predicting which is likely to go. Data on the virus, data on the healthcare systems, data from the big data collection that tells us how the economies are doing. However, the question is, how could we incorporate this exogenous knowledge of new structure and structural changes without introducing also new mistakes and new potential issues with the model? So with that, let me stop and see if you have any questions. Okay, so I have a number of questions here on the chat. Let me see if I can answer some of them. So the first question is there a way to train new models based on COVID-related data sets? I think that there is. The question is, how permanent is that training likely to be? I think the relationships may change over the next year as we get a vaccine, et cetera. So I worry that the frequency with which that data is available is not suitable for the rapidity of the changes that are occurring for medium-term prediction. So the next question is, will the AIML area be facing any challenges post-COVID? I think we addressed that. Another one is, what steps are you taking to deal with the uncertainty in the models? I think that, we have not been using AIML models directly in our alpha generation. As we do, we will have to be cognizant of these issues, and we will have to have an extraneous check, to make sure, that we are not misled as we go forward. Would I say that the black swan event is already reflected in the current models? Absolutely not. I think it's impossible for any model to have fully reflected an event that is still in progress. And then the next question is, how do I compare the model-driven decisions to human-driven irrational exuberance around bubbles? That's a fantastic question. Of course, human beings may be no better at predicting the future during COVID than a model could. I think what is required is potentially a hybrid approach here, where the model is used to keep you sane and grounded in historical relationships, while you test out new structural relationships that are based on our knowledge of the real world. And we combine these in a way, to come up with the best predictions. So is COVID a black swan or a white swan? I think it's a white swan, or it's not a swan at all. Perhaps it is a crisis that had been predicted, that was expected, but its magnitude, its timing, and the nature of the crisis were not, of course, known beforehand. Okay. How about weighing more recent information more and online reinforcement learning? I think that those would be more and more useful once the world settles down to a given pattern. My concern here is that the recovery may offer a pattern very different from going forward than what we've seen so far. For example, as I mentioned, there's been an emphasis in technology-driven rally since March. But at this point, as the economy comes back and as valuations on the technology side become very high, it might be that new capital goes into other parts. For example, the portions of the economy that are most affected, airlines or banks or real estate. And eventually hotels, travel, etc. I think that model outputs need to be subjected to human checks and structural checks based on what we know the structure of reality to be. And let me leave it there. I think that we are running into the end of the session. You're welcome to visit us at BasisPointGlobal.com, and any questions that we didn't answer in this session, I'll be happy to converse with you offline. Thank you.